Preparing for a financial analyst and controllership roles at American Express India interview? You've reached Candy Mentor, and this video is for you. We'll walk through 15 key questions you're likely to face. For each one, you'll see what the interviewer is testing, the core concepts you should cover, and a sample answer. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Walk me through how you would manage a month-end close for a controllership role. The interviewer wants to assess your practical close experience, understanding of timelines, journal entries, reconciliations, review controls, documentation quality, and ability to deliver accurate financials under pressure. While answering, focus on close calendar discipline, accruals, reclasses, reconciliations, variance review, evidence retention, reviewer sign-offs, and how you escalate unresolved issues before reporting deadlines. In a controllership close, I start with the close calendar, ownership matrix, and key dependencies. I validate source feeds, post accruals and reclasses, complete reconciliations, and review unusual movements against prior month and forecast. For high-risk accounts, I check supporting schedules and approvals before submission. I also track open items with clear aging and resolution owners. My aim is a timely close with accurate numbers, strong documentation, and no surprises for reviewers. Question 2. If actual expenses are significantly higher than forecast, how would you investigate the variance? This question evaluates your FP&A mindset, analytical structure, ability to isolate drivers, distinguish timing from true business impact, and communicate actionable variance commentary to stakeholders. Make sure to cover variance decomposition, volume versus rate impact, one-time versus recurring items, timing differences, accrual accuracy, business owner discussion, and clear commentary with corrective actions. I would first quantify the variance by account, cost center, and business driver, instead of looking only at the total. Then, I would separate timing items from genuine overspend, check whether accruals or invoices were booked correctly, and compare run rate trends. For example, if marketing spend is up 20%, I would ask whether campaigns launched early, rates increased, or volume changed. Finally, I would summarize the root cause, forecast impact, and recommended action. Question 3. What are the key financial statements, and how are they connected? The interviewer is testing your accounting foundation, especially whether you can connect profitability, balance sheet movements, cash flow, and retained earnings without giving a memorized textbook answer. In your answer, talk about income statement profitability, balance sheet position, cash flow conversion, net income linkage, depreciation add-back, working capital, debt, equity, and retained earnings. The 3 core statements tell one connected story. The income statement shows performance over a period, ending with net income. Net income flows into retained earnings on the balance sheet after dividends. The cash flow statement starts with net income and adjusts for non-cash items like depreciation and working capital changes. The ending cash balance then links back to the balance sheet. So profit, financial position, and cash generation should reconcile with each other. Question 4. How would you explain accrual accounting to a non-finance stakeholder? The interviewer wants to assess your conceptual clarity and communication style, especially your ability to simplify accounting principles for business teams while preserving accuracy and control implications. Be sure to mention matching principle, recognition when earned or incurred, not when cash moves, expense accruals, prepaid expenses, revenue timing, and why accruals improve decision-making. I would explain it using a simple example. If we receive services in March, but the vendor invoice arrives in April, March should still reflect that expense because the business consumed the service then. Accrual accounting matches revenue and expenses to the period they relate to, not just when cash is paid or received. This gives leaders a more accurate view of performance and prevents 1 month from looking artificially good or bad. Question 5. What controls would you expect around journal entries in a large financial services company? This question evaluates your understanding of controllership governance, SOX-style controls, maker-checker discipline, authorization, audit trails, segregation of duties, and fraud or error prevention. While answering, focus on preparer-reviewer workflow, supporting documentation, approval thresholds, restricted access, automated validations, recurring journal review, manual journal risk, and periodic audit testing. Journal entries need strong preventive and detective controls. I would expect maker-checker approval, clear supporting evidence, proper account coding, and approval based on materiality or risk. System access should prevent the same person from preparing and approving an entry. Recurring journals should be reviewed periodically, not rolled forward blindly. Manual entries deserve extra scrutiny because they bypass normal transaction flows. Good controls create traceability from business event to accounting impact. Question 6. How would you perform and review a balance sheet account reconciliation? The interviewer is testing your reconciliation discipline, ability to identify aged breaks, assess recoverability or validity of balances, and maintain audit-ready documentation for financial reporting. Make sure to cover ledger to subledger matching, supporting schedules, aging analysis, reconciling items, ownership, materiality, write-offs or adjustments, certification, and timely clearance of open items. A good reconciliation proves that the general ledger balance is complete, valid, and supported. I would compare the GL to subledger, bank statement, vendor schedule, or other independent support. Then I would list reconciling items, age them, assign owners, and determine whether adjustment or follow-up is required. Long outstanding items are red flags. As a reviewer, I would challenge unsupported balances, unusual trends, and repeated roll-forward comments without real resolution. Question 7. American Express is a card and payments business. What finance metrics would you track for performance analysis? This question evaluates whether you understand American Express business drivers, including billed business, revenue streams, credit risk, customer economics, operating expenses, and profitability by segment. In your answer, talk about billed business, discount revenue, net interest income, card member spending, loan balances, credit losses, rewards cost, operating expense ratio, and customer acquisition metrics. For a payments business like American Express, I would track both growth and risk-adjusted profitability. Key metrics include billed business, active card members, average spend, discount revenue, net interest income, loan balances, delinquency, and net write-off rates. I would also watch rewards expense, marketing spend, customer acquisition cost, and operating expense ratio. The important point is not just transaction growth, but whether that growth converts into sustainable earnings after rewards, credit losses, and servicing costs. Question 8. How do you ensure accuracy when preparing management reports or dashboards? The interviewer wants to assess your reporting controls, data validation habits, attention to detail, ability to handle recurring MIS processes, and confidence in numbers presented to leadership. Be sure to mention source validation, tie-outs to ledger or approved systems, variance checks, version control, formula review, automation where possible, commentary validation, and stakeholder sign-off. I treat reporting as a controlled process, not just formatting numbers. First, I confirm the data source and extraction period. Then I tie key totals to the ledger, forecast system, or approved dataset. I use variance checks, reasonableness tests, and formula reviews before circulation. If commentary comes from business teams, I validate whether it matches the numbers. I also maintain version control because leadership decisions depend on one consistent, and explainable view. Question 9. What is the difference between a provision, an accrual, and a contingent liability? The interviewer is testing your technical accounting judgment, especially recognition thresholds, measurement uncertainty, probability assessment, disclosure requirements, and ability to avoid misclassification in financial reporting. While answering, focus on timing certainty, obligation existence, reliable estimate, probability of outflow, normal expense accruals, provisions for uncertain obligations, and disclosure-only contingent liabilities. An accrual is typically for an expense already incurred, where timing or invoice receipt is pending, such as utilities used but not billed. A provision is also a liability, but it involves more estimation uncertainty, like restructuring or legal obligations, where an outflow is probable and reasonably estimable. A contingent liability is a possible obligation depending on a future event. If it is not probable or cannot be measured reliably, it may be disclosed rather than recorded. Question 10. How would you build a forecast for operating expenses for the next quarter? This question evaluates your forecasting approach, ability to combine historical trends with business inputs, handle fixed and variable costs, and produce assumptions that stakeholders can defend. Make sure to cover baseline run rate, seasonality, known initiatives, headcount, vendor contracts, inflation, one-time items, business owner inputs, scenario analysis, and comparison against budget. I would start with the current run rate by cost category and remove one-time items. Then I would layer in known drivers such as headcount plans, vendor contracts, project spend, inflation, and seasonality. For variable expenses, I would link the forecast to activity levels rather than using a flat trend. I would validate assumptions with budget owners and create upside and downside scenarios. A useful forecast should explain what changed, why it changed, and what management can influence. Question 11. Describe a time you found an error in financial data. How did you handle it? The interviewer wants to assess ownership, integrity, problem solving, communication under pressure, and whether you follow a structured approach to correcting financial reporting errors. In your answer, talk about identifying the issue, quantifying impact, checking root cause, notifying stakeholders, correcting the entry or report, strengthening controls, and documenting the resolution. In one reporting cycle, I noticed travel expense was materially lower than trend despite normal business activity. I traced the data and found a file load failure from one cost center. I quantified the impact, informed my manager before reports were finalized, corrected the dataset, and refreshed the variance commentary. Afterward, I added a control check, comparing source file totals to dashboard totals. The key lesson was to escalate early with facts, not assumptions. Question 12. How comfortable are you with Excel? And what functions or tools do you commonly use in finance analysis? This question evaluates your hands-on analytical capability, efficiency with large data sets, model hygiene, automation mindset, and ability to produce reliable analysis using common finance tools. Be sure to mention lookups, pivots, sum-ifs, index match or XLOOKUP, Power Query, scenario tables, checks, formatting discipline, error controls, and experience with large datasets. I use Excel heavily for analysis, reconciliations, and reporting. My regular tools include pivot tables, sum-ifs, XLOOKUP, index match, conditional formatting, data validation, and basic Power Query for cleaning repeat files. I also build control checks, such as totals that tie to source data and flags for missing mappings. For finance work, speed matters, but reliability matters more. I prefer clean structure, transparent assumptions, and formulas that another reviewer can follow. Question 13. How would you deal with a business stakeholder who disagrees with your expense variance commentary? This question evaluates stakeholder management, professionalism, evidence-based communication, ability to challenge constructively, and judgment in balancing business explanations with finance accountability. While answering, focus on listening first, aligning on facts, using data support, distinguishing explanation from ownership, updating commentary when valid, and escalating only when necessary. I would first understand what part they disagree with: the number, the driver, or the wording. Then I would walk through the data source, period, and calculation, so we are aligned on facts. If they have additional context, such as a timing shift or approved initiative, I would update the commentary. If the data supports my view, I would explain it professionally and keep the wording objective. The goal is accuracy, not winning an argument. Question 14. What is SOX, and why is it important for controllership teams? The interviewer is testing your understanding of internal control frameworks, financial reporting reliability, audit readiness, control ownership, evidence requirements, and compliance expectations in a U.S.-listed company environment. Make sure to cover Sarbanes-Oxley purpose, internal controls over financial reporting, risk of material misstatement, control design, operating effectiveness, evidence, testing, and remediation. SOX refers to the Sarbanes-Oxley requirements around reliable financial reporting and internal controls, especially for U.S.-listed companies. For controllership teams, it means key processes must have well-designed controls, clear ownership, proper approvals, and evidence that controls operated effectively. Examples include journal approval, reconciliations, system access, and report validation. If a control fails, the team must assess impact and remediate quickly. Strong SOX discipline protects both the company and the integrity of reported numbers. Question 15. Why do you want to work in a finance or controllership role at American Express India? This question evaluates motivation, company awareness, role fit, long-term interest in finance operations, and whether you understand American Express India as a global capability and control environment. In your answer, talk about American Express brand, payments and financial services exposure, controllership rigor, global stakeholders, analytical work, process excellence, ethics, and your career alignment. American Express appeals to me because it combines a strong global brand, a data-rich payments business, and high standards of financial discipline. In a finance or controllership role, I would get exposure to reporting, analysis, controls, and global stakeholder management. That matches my strengths in accuracy, structured problem-solving, and business partnering. I am also attracted to the India Capability Center environment, where finance teams support critical global processes and can drive automation, control improvement, and decision support. If you are still with us, congratulations! You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.